Hello guys, see Devang Maheshwari this side. Markets have crashed a lot and I know you are looking out for stocks right now. So here I come. In this video, we'll discuss about top 3 stocks in the pharma sector that you can watch out right now. So let's begin. Before beginning, let me tell you two things. None of the stock is a recommendation, and secondly, each of the stock goes through a power investing framework, which is basically a process driven investment system taking care of both the fundamental health of the company and the technical health of the company so that you get the best of both worlds. The first stock is Alkem Labs. The current market price of the company is somewhere around 2650 to 2700. Let me tell you top 5 facts about Alkem Labs. First one, it's the 6th largest pharmaceutical company in India. Second, it has 8 big brands that contributes in totality of sales of $1 billion. Third, it has 45 research and development and manufacturing units across. Fourth one, if you break the revenue of the company, 67% of the revenue comes from India, 27% of the revenue comes from United States of America, and the balance 6% comes from the rest of world, that are from various other countries. If you break up the entire revenue, you will get 7 revenue segments for the company. The top 2 segments are first anti-infectives and the second gastro. What are anti-infectives, by the way? Anti-infectives include antibiotics, antifungals and all the medicines that are basically used to kill bacteria and infections. This segment contributes around 40% of Alkem's sales. That is, this is the biggest segment for Alkem Labs. Have you heard about the medicine Clavim? That's one of the big antibiotics that the company manufactures. Clavim has around 15% market share. I bet you would have taken that medicine at some point of time. The second one is the gastro segment. Now what's gastro segments? It basically deals with the indigestion, heartburn and stomach acidity related problems. This segment contributes 19% of the overall sales. However, there are other 5 segments also which contributes less than those and in single digits. These are pain management, neuro related, skin related, cardiac related, vitamin nutrients related. These are the remaining 5 segments of the company. Now let us look onto the financial part of the company. The top things that you need to understand right now is that the company has a debt equity ratio of just 0.24. How is that important? That's important because it is indicating that the company has a solid foundation. It generates sufficient cash to fulfill its future growth, and it doesn't need an outside borrowing to run up the company. That's why it's a solid foundations. Second thing, just the foundation is of no use if you are not able to generate profits and if you are not able to grow using that foundation. If you look upon the profitability side of the companies, you will find very good return ratios. Return of equity of around 15%, and that's been consistent since few years. Return on assets of around 12%. Net profit margin of the company is around 10.3-10.4%, which is very good, by the way. If you look about the efficiency part of the company, asset turnovers are greater than 1, which is basically telling you that company is using its fixed assets in a very good manner. Now the growth part. In the last 5 years, the sales growth for Alkem Labs have been 20% CAGR, which is a very solid growth case. And not only the sales growth, the profit growth, it's been 12% CAGR for the last 5 years. That gives it all the characteristics of a growth company with profitability and a solid foundation. As I said to you, the power investing takes care of both the fundamental part of the company and the technical part of the company also. Fundamentally, we already understood. If you look technically, Alkem Labs is in a good strong trend. And when I say that, it means that in the recent crash, there was not much fall into the Alkem Labs, which is again telling you that big money is after it. So fundamentally, it passed on to over parameters technically also it's fulfilling the parameters. The second company that we are about to discuss is Ipca Laboratories. You would have heard recently about a medicine called HCQ200, hydroxychloroquine. I don't even able to pronounce the name correctly. Its technical name is HCQ200, and it has been rumored that the medicine is a good case for treating COVID-19. That sounds exciting, right? You got the company that makes up the medicine. That's not a case for excitement, because even if that medicine works upon, it contributes very less of Ipca Labs. It contributes just 6% of the entire sales, and the company was even growing without that medicine. So let me tell you the top 3 facts for Ipca Labs. The company makes medicines primarily into 2 major segments. The first one is into pain management, and the second is cardiovascular. In pain management, the company has 46% revenue share, and in cardiovascular it has around 20% revenue share. If you compare that revenue segment with Alchem Labs were deriving 40% of its sales from the anti-infectives, and Ipca Lab is deriving 46% from the pain management, so that these 2 companies are not in the same segment, and that's why I've taken it in this video. The company is also into other segments like anti-malarial and also into antibiotics, but these contribute comparatively less percentage to the overall sales. To break down the entire sales into branded generics, the branded segment contributes around 50% of the entire sales. Second one is generics, which contribute around 19%, and active pharmaceutical ingredients, which contributes around 24% of the entire sales. Oh, now what's active pharmaceutical ingredients? Active pharmaceutical ingredients, basically short form API. These are the basic drug that goes through the medicine in your body and fights against the symptoms. You can call this as the deciding drug in the medicine that's fight up the symptoms and make you feel better. Third fact about the company is that company exports 48% of its revenue, and primarily to Europe, Africa and United States of America. Looking onto the financials of the company's debt equity ratio is of around 0.15, which is very good, and why I told you earlier. Second thing, the company's return ratio is very good. The company's return on equity, return on capital employed is greater than 15%, and it looks sustainable. Asset turnovers are greater than 1.3, which is again one of a good character. If you look upon the growth part of the company has been growing very good since last 2 years. In the recent 9 months, the company's sales growth have been in range of 20-22%, and the profit growth around 52% in the last 9 months year on year. In the previous year, the company's revenue grew by 15%. Together, this gives a classic case of a growth company that's been giving good profits and with a solid foundations, and these 3 parameters are very crucial parameters for any company. Now looking on to Ipca Labs, technically it's looking again very strong, and there has been not much fall in the recent crash. Together these fundamentals which I told you why it is good, and the technicals, it again makes a good case to look into. There are many people who bought Ipca Labs based on the HCQ200 story. However, for all you guys, it contributes very less to Ipca Labs, and there is still a debate going on that whether that medicine is good or bad. So HCQ is not a growth part for the company. The growth part for the company comes from the pain management and the cardiovascular, and also from the API segment, which has been growing good. Now the third company is a pure play API company, and when I say pure play, what does that mean? That means that this company derives 93% of its sales from active pharmaceutical ingredients. If you break that into the segments, the company's top 2 segments are into antibiotic API, which contributes 41% of the sales, and anti-diabetic API, which contributes 13% of the sales. Now what's the name of the company? Name of the company, I know it's tough. The name is Aarti Drugs Limited. Let me give you a brief about the API industry currently. India imports 70% of its API requirements from China. These API are then used by the pharma sector to make up the medicines, package it, reach out to the chemist from which you buy up, and then it goes into your body, and that API is the drug that fights up with the disease. 70% of this has been imported from China. In the recent COVID-19 situation, that is in the last 2 to 3 months, the government was shocked. Not shocked because it was something new with regard to the API industry, but the government realized that the dependence of API on China is a very serious threat to the entire healthcare of India. Because if this situation arises again, you can't do anything without those API. Pharma companies cannot make medicines if that chemical is not brought from China. And the recent supply chain disruptions, it was a serious final knockoff in the government's head that something now needs to be done for this sector. Keeping that in mind, the government has created an incentive scheme of 10,000 crore rupees. Along with that, the government is also making up bulk drug parks. Bulk drug is another name for API, and the government is trying to make such infrastructure facility so that the entire industry can grow and our dependence on the China gets reduced. Not only that, API industry generates a lot of pollution, and because China was one of the major global leader in the API manufacturing, there was a huge pollution crisis since last 3 years, and as a result of that, many API companies have been shut down from it, and already some sales due to that reasons have started coming to India in the last 1.5 to 2 years. The third thing with regard to this industry is that the entire globe has now understood this, that they need to remove their dependency from China and make a model which is China plus one, that is an alternate manufacturing capacity somewhere else in the globe. And India being a significant pharma players, having all that capabilities that's needed for the sector to grow, already having various API companies, was needing some government support so that it can grow upon. Aarti Drugs is a small cap company that has a current market cap of 1700 crores only, and it has been growing good by 25-26% since last 2 years. India imports 70%, as I said, even a small percentage change from China to India. Due to what? Due to meeting the demand of Indian pharma and due to meeting the demands of the entire globe. Even if such small percentage shifts to India, in this sector there can be huge multi-baggers that can be created upon, that are consistent, sustainable, long-term stories. Looking onto technically, Aarti Drugs is again breaking out of the last 5 years of consolidations, that is from 2015 to now. Also, it's showing huge relative strength on the charts, that is, it has not fallen much in the recent crash, which again makes it a good case fundamentally and technically to look into. So these are the 3 companies. Also, I have a bonus for you guys. I know you guys like bonuses. I have 2 more API companies which looks very solid case for investments. If you want me to make a video on those companies, please comment below and I'll make a video for you. Hope you find this video insightful, and I again repeat that none of the stock was a recommendation. See you guys